If you asked me to reduce most investing failure to one sentence, I would say this: people do not lose the most money because the world is unknowable. They lose the most money because they behave as though it is. I have spent most of my life around markets, businesses, annual reports, management teams, crises, bubbles, recessions, recoveries, and the strange emotional theater that human beings build around money. And after all that time, I can tell you something very simple. Investing is not mainly a test of intelligence. It is a test of temperament. It is a test of whether you can think clearly when other people become excited, frightened, envious, impatient, proud, or paralyzed. The world likes to imagine great investors as men with magical formulas. It imagines hidden screens, secret models, and mysterious instincts. That makes for a more flattering myth. The truth is both more useful and less glamorous. A great deal of successful investing comes from avoiding a short list of very expensive human mistakes. I have made some of them myself. Charlie has made some. Ben Graham made some. Almost every intelligent investor you admire has made some version of them. That is why I want to speak plainly about the errors that keep repeating, not because they are dramatic, because they are ordinary. They are so ordinary that people stop seeing them, and because they stop seeing them, they keep paying tuition to them over and over again. The first mistake is trying to predict the market itself. This one seduces almost everyone sooner or later because it is so emotionally appealing. The market goes up, you want to know when it will stop. The market goes down, you want to know when it will bottom. The economy looks weak, you want to know when the Fed will cut, when inflation will cool, when war will end, when confidence will return, when the next rally begins. That urge is understandable. It is also, for most people, highly destructive. Charlie and I never built Berkshire by forecasting the next 6 months of the stock market. Ben Graham occasionally drifted toward trying to read the market's mood, and even he was better when he stayed anchored to the business rather than the crowd. I learned early that the stock market is too large, too emotional, too connected to too many unknowable variables to become a dependable object of prediction. People call that humility. I call it arithmetic. To forecast the broad market, you would need to be right on interest rates, politics, inflation, war, sentiment, credit conditions, energy, labor, valuations, fiscal policy, and 100 other things that move together in ways nobody fully controls. You may guess right once. You may even guess right a few times. That is not the same thing as building a reliable investing life. I know many people who have done very well identifying superior businesses. I know almost nobody who built great wealth by consistently predicting the mood swings of the market itself. That is why I prefer to ask a different question. Is this business likely to be worth more in 10 years than it is today? And am I paying a sensible price relative to that future? That is an easier question. Not easy. Easier is a tremendous advantage in investing. I do not need to know what Jerome Powell says next month to know that a truly strong business with durable economics will likely be worth more after a decade of good management and retained earnings. There will be storms. There will be ugly periods. There will be recessions and manias and newspaper headlines written by people who need you emotionally engaged. Let them have the headlines. I want the business. That is the first principle. Do not turn market prediction into a requirement for investing success. It is too difficult, too seductive, and too unnecessary. The second mistake is becoming emotionally attached to your purchase price. This one sounds so childish when you say it out loud that people assume they are immune to it. They are not. A stock bought at 100 falls to 50, and the owner feels violated. Another person bought the same stock at 10 and feels delighted. The stock does not care. The future return from 50 onward is the same regardless of what story you tell yourself about your personal history with it. That is what makes this mistake so expensive. People think they are making rational decisions. Often they are simply defending their ego. A man who paid too much for a stock wants to hold until he is whole again, because selling below his cost feels like admitting failure. Another man with a large gain wants to sell quickly because he wants the emotional pleasure of locking in victory. Both can be wrong for exactly the same reason. They are not asking what matters. They are asking what makes them feel better about the past. The past should interest you only if it teaches you something useful. It should not govern today's capital allocation. If I wake up this morning and a stock is sitting in front of me at $50, I have one question from here. What is the expected return relative to the risk and the alternatives? That is all, not what I paid, not how I feel, not whether I look smart or foolish. Capital should not be managed like a wounded marriage. It should be managed like capital. This lesson cost me dearly more than once. I have watched things run away from me because I anchored to an earlier price. I have watched opportunities stay obvious while my mind kept saying I should have bought lower, or I should wait for the old number, or it no longer feels as attractive because the price moved before I finished negotiating with myself. That is a very expensive internal conversation. A company does not owe you your preferred entry point. If the economics are still excellent, the price may still be sensible, even if your feelings are not. The third mistake is assuming aggressive growth will rescue a rich valuation. This one is particularly dangerous because it flatters the imagination. A stock looks expensive on present numbers, and the investor says to himself, yes, but if earnings just keep compounding at 15 or 20% for years, then the current price will soon look cheap in hindsight. That sentence has destroyed more discipline than most market crashes. Growth matters, of course it matters. I love businesses that can grow without requiring too much capital, because that is one of the most beautiful engines in finance. But growth at any price is not intelligent. It is wishful thinking wearing a suit. Very few large companies sustain very high growth rates for long periods. That is not pessimism. It is how competition, scale, saturation, and gravity work. The larger the base gets, the harder it becomes to keep growing at absurd rates. That is why I always laugh a little when management teams casually promise 15% annual growth as if they were ordering lunch, maybe for a while, not forever. And when the stock price already assumes something close to perfection, merely good results can be disappointing. That is another lesson people ignore. A company can report excellent growth and still become a poor investment if the price embedded fantasies that reality only partially fulfilled. This is why valuation still matters, even for great businesses, especially for great businesses that the public loves enough to overpay for. You should be suspicious whenever your investment case depends on a long stretch of unusually high growth, simply to make today's price seem reasonable. Sometimes that works. More often it is a trap built from optimism, not mathematics. The fourth mistake is leverage. If there is one direct route through which a smart person can take a sound idea and still ruin himself, it is leverage. Leverage is the financial equivalent of saying, I am not only willing to be right, I am willing to be right on a timetable set by somebody else. That is insanity masquerading as efficiency. I have known many intelligent people hurt by leverage. Some were brilliant, some were experienced, some were even right in the end about the underlying business, security, or market direction. It did not matter, because leverage introduces a cruel additional variable. Survival without leverage. Being early is painful. With leverage, being early can be fatal. That is why I have always preferred sleeping well to maximizing excitement. A borrowed portfolio may produce handsome returns in calm weather. It may also turn a temporary drawdown into permanent damage if the lender can demand action from you during the exact worst moment of a general financial disaster. then the market no longer needs to disprove your long-term thesis. It only needs to move against you hard enough, long enough, and at the wrong moment, that is all. I do not like games where a correct view can still end in ruin because the structure was wrong. Short sellers learn this painfully. So do real estate speculators. So do aggressive traders. So does anyone who mistakes borrowed confidence for skill. There is a reason Charlie and I never built Berkshire on Russian roulette with better vocabulary. The fifth mistake is getting lost in detail and missing the business. This one is common among intelligent people, because intelligence likes detail. Detail creates the feeling of seriousness. It creates the feeling that you are doing the work. Sometimes you are simply hiding from the larger judgment that actually matters. When I evaluate a business, I care deeply about the economics of the business and the quality and honesty of management and the price I am being asked to pay. If those three things are right, many smaller details matter less than people think. That does not mean details are useless. It means details must remain servants, not masters. I have seen people spend weeks on minor legal footnotes, isolated product trivia, tiny product-level arguments, or fashionable metrics that make the process feel sophisticated while never truly answering the essential question. Is this a good business run by the right people at the right price? That is the forest. Too many investors get hypnotized by the trees. Now, I understand the temptation. I feel it myself sometimes. Research can become a kind of psychological shelter. The more detail you gather, the less exposed you feel to the final act of judgment. But investing is not won by collecting the most facts. It is won by identifying the decisive facts and assigning them proper weight. The sixth mistake is trying to jump over 7-foot bars when 1-foot bars are available everywhere. This is one of my favorite lessons because it sounds almost too simple for serious people to accept. In many parts of life, difficulty is glamorous. Hard mountain, hard exam, hard proof, hard sport, hard engineering challenge. We admire the person who does the difficult thing because difficulty itself looks like evidence of superiority. Investing does not work that way. You do not get extra points. You do not get a larger return because your thesis required more Greek letters, more assumptions, or a deeper excursion into uncertainty. Sometimes the best investment is the easiest one to understand. A plainly superior business in a durable industry with honest management and a sensible valuation may not look intellectually dramatic, but it is often exactly what you want. I have never believed complexity deserves a premium by itself. Often it deserves a discount because it creates more places for error. There are people who seem to think a 7-foot problem must offer richer rewards than a 1-foot problem. That is often false. The 1-foot bar in investing can be incredibly profitable because the point is not to impress the crowd with athletic style. The point is to get over the bar safely. Repeatedly, the 7th mistake is shrinking your universe of possible ideas too much. This is subtle because it sounds like discipline at first. People say, I only invest in this sector, or this country, or this theme, or this style, or this kind of company with this exact characteristic. They think they are protecting themselves by creating a narrow identity. Sometimes they are just starving themselves of opportunity. A circle of competence is necessary. Narrow-mindedness is not. Those are different things. I like staying within what I can understand, but I do not like arbitrary limitations that remove opportunities simply because they do not fit a brand. Markets do not care what fits your brand. Opportunity appears where it appears. Some fund managers restrict themselves into little boxes because boxes are easier to market. The public likes niches. Niche sounds precise. It sounds intentional. It also often means the manager has fewer fish in the pond and more pressure to catch something from the wrong place, because his mandate will not let him move. I prefer a wider field with a strict filter. That is a far healthier way to think. My fishing rule has always been simple. If the fish are not here, move, not because you lack patience, because patience and stubbornness are not the same thing. The eighth mistake is feeling you must always be active. This is one of the most destructive social pressures in investing, because so much of modern finance is built to make inactivity feel irresponsible. A manager wants to appear useful. A commentator wants to appear informed. An investor wants to feel engaged. So people buy, sell, rotate, rebalance, trim, hedge, trade, and generally keep their hands moving because stillness feels like laziness. That instinct is ruinous. Investing rewards waiting in a way that almost nothing else in life does. The baseball analogy is perfect here. In baseball, if you stand there forever without swinging, the umpire will punish you in investing. There is no such punishment. You can stand there and wait as long as you like. You do not have to swing at every pitch. You only need to swing at the fat pitch. That is a magnificent advantage. Most people refuse to use it. They think activity proves seriousness. Often it proves insecurity. I would rather make a few large, intelligent decisions a year than 50 mediocre ones. You do not need constant action. You need occasional action when the odds are unusually favorable. That is an entirely different life. The ninth mistake is excessive diversification. This subject always creates noise because people hear slogans instead of context. Diversification is useful when you do not know much. Diversification is protective when your knowledge is broad but shallow. For the average person who does not want to study businesses, broad diversification through index funds makes excellent sense. But if you truly know businesses, if you truly understand the economics of a handful of great companies, then over-diversifying can dilute your best ideas. You do not get rich from your seventh best idea nearly as often as you do from your best one. That is simply true. I am not arguing for recklessness. I am arguing that knowledge should have weight. If you understand 6 wonderful businesses deeply, owning 50 mediocre or merely acceptable ideas beside them may not be prudence. It may be self-protection from conviction. People like to hide inside diversification because it softens accountability. If everything is average, nothing looks like a mistake in particular. That may be emotionally pleasant. It is not always financially powerful. The 10th mistake is confirmation bias. Charlie used to say that the human mind is very good at taking new information and bending it in a way that protects existing conclusions. He was right. I have seen this in others, and I have seen it in myself. Once a person falls in love with a stock or a thesis or a management team, his brain begins acting like a lawyer instead of a judge. It starts gathering favorable evidence, explaining away contrary facts, and protecting the original position from fresh evaluation. That is tremendously expensive, because the market does not care what story you are emotionally committed to. If the facts change and you keep defending the old view because it is yours, the market will charge you for the sentimentality. I have found 2 good antidotes. The first is to force competition among ideas. If I am considering adding something to the portfolio, I do not want to compare it against emptiness. I want to compare it against real alternatives that I also understand. That helps kill attachment because every idea must earn its place. The second is to deliberately seek the bear case. Make yourself read the strongest argument against what you want to believe. Better yet, find someone intelligent who disagrees with you and let them try to wound your thesis. If it survives, good. If it does not, you avoided something costly. The 11th mistake is following the herd. Human beings are social animals. That is useful in most of life. It is dangerous in markets. In many parts of life, the crowd contains valuable information. A good restaurant, a safe neighborhood, a movie most people enjoy, A social signal can help you. In investing, broad agreement often means the obvious case is already priced in. That is the problem. A good company is not automatically a good stock, not at every price. A bad company is not automatically a bad stock, not at every price. The herd usually notices stories late and feels strongest about them after much of the easy money has been made. Then it mistakes social certainty for economic advantage. This is why some of the ugliest investments are those that make people around you rich very quickly. Their success becomes a kind of emotional gravity. You feel foolish staying away. You feel left behind. You begin telling yourself that maybe your standards are too old or too strict or too boring. Then you throw discipline away because somebody else's return looked easy. I have seen many intelligent people lose their minds this way. One of the greatest edges Charlie and I had was not that we were right more often than anyone else in some magical sense. It was that we were less willing than most to let the crowd tell us what to feel. That matters enormously. The 12th and final mistake is omission. This may be the biggest one of all. People often think investing mistakes are mostly things you bought that went wrong. Some are, but some of the costliest mistakes in my life were opportunities I understood well enough and still did not act on decisively. These are painful because they combine knowledge with hesitation. Something is within your circle of competence. Something is clearly attractive. Something is priced well enough. And yet you linger, you nibble, you wait for a slightly better price. You want another day, another quarter, another bit of reassurance, another piece of confirmation. Then the opportunity runs away from you. The world sees the final result and thinks you missed a stock. What you really missed was a moment where conviction should have outrun caution by a little. I did this with Walmart. I almost did it with Sears. I have done it enough times to know the cost. This is where the earlier mistake of anchoring to price becomes especially destructive. You like the business at one level. The price rises a little. You tell yourself it is no longer as attractive because you are comparing it to the old number, not to its actual long-term value. Then you wait. Then the stock keeps compounding. Then you spend years learning what an expensive preference for a slightly better entry point can cost. That is why omission hurts so much. You usually see clearly afterward that you knew enough. You just did not act. When something is deeply within your circle of competence, when the odds are unusually favorable, when the business is truly strong and the price still makes sense. There are moments in investing when caution itself becomes the mistake. Most people never learn that balance. They are either too eager everywhere or too timid where it matters. I have tried very hard to avoid both extremes. If you asked me to summarize all of this in one final thought, it would be this. Investing success is not mainly about finding hidden brilliance. It is about avoiding ordinary stupidity long enough for good judgment to compound. Do not predict the market. Do not marry your purchase price. Do not let heroic growth assumptions justify foolish valuations. Do not use leverage. Do not drown in details and miss the business. Do not prefer difficult problems to easy, profitable ones. Do not unnecessarily shrink your opportunity set. Do not stay active just to feel alive. Do not diversify away your best ideas if you truly know them. Do not protect your thesis from contrary facts. Do not follow the herd into expensive certainty. And when you clearly recognize a rare, wonderful opportunity within your competence, do not stand there sucking your thumb. That is as close to a practical investing code as I know how to give. The market will always tempt you in the opposite direction. It will try to excite you, frighten you, flatter you, distract you, and tire you into mistakes. You do not have to cooperate. That is your edge.